lot of commentators are now describing the earnings season that we've just been through in Australia as being the best in 20 years. You know, it's a phenomenal experience for investors, especially given that we've moved into the cycle where earnings are going to drive share prices. If I look to quantify what really happened, so the level of excess that companies delivered relative to expectations equates to around $4.8 billion worth of profits for shareholders. Now that's a very large number. It's also large when I think about the historical experience that we normally have during this time, which is that we typically are disappointed. So investors, based around what analysts' expectations are set, are typically too high. So human nature is that people are optimistic and there's a bullishness associated with the way that they try and present their expectations. And typically companies, struggle to meet those expectations as we move into this period. It was very, very different this time. In fact, right across the different sectors and right across all the stocks that we were looking at, there was an overwhelmingly positive nature to the outcomes that we saw. It's interesting when I think about where it came from. So the revenue line was very strong. When I think about the economic experience that we're going through in New Zealand and Australia at the moment, it's very, very positive, so much better than we ever expected. I saw some data, just this morning. So business confidence levels now in Australia at the highest level in 10 years. Consumer confidence numbers are being reported well in excess of where we were pre-pandemic. Unemployment numbers have come back, substantially, and you've got unemployment now in Australia at around, or just slightly higher than 6%, in New Zealand just below 5%. So again, a very constructive environment for corporates to generate sales and revenue. So that was a big tick. We saw cost management was executed on very, very well, and so we saw margins expand, and we saw capital management executed also in a very prudent fashion. And I raise that because what that's created is a platform for dividends to exceed expectations as well. And so if I think about where we have got to now with respect to expectations for dividends in Australia relative to where we were only a few months ago, they've been lifted by 9.2% for the year finished June 2021. And what that equates to is an additional $6.2 billion of dividend payments being paid out to shareholders if these expectations are met, or these new expectations are being met. So again, a really, really positive environment. If I come back to New Zealand, slightly different. So we have, again, we had a really good reporting season in New Zealand, and again, one of the better ones that we've had for quite some time for the majority of companies. But the problem was that we actually had a really acutely underperforming equity market, despite that backdrop. And in fact, I think it was the second worst performance that we've seen during the month of the reporting season in the past 20 years for the New Zealand market. So it fell around 7%. And the reason for that, it's highlighted by some of the idiosyncratic factors which ultimately define this New Zealand market. It's a very small market. It's very concentrated in certain areas. And what we are prone to is effect from the performance of just one or two stocks. So despite the fact that the overall earnings backdrop is getting better, we had a situation where Fisher & Paykel Healthcare as a company fell. And look, it's certainly one of our best companies in the listed market here in New Zealand. And it was a wonderful beneficiary of what happened with COVID. So as we saw hospitalisation rates begin to lift around the world, we saw a real lift in demand for their products in terms of ventilation and oxygen therapy. And as everybody would expect, we've now moved into this new world where we've had the development and the rollout of vaccines, and there is a really high level of expectation and optimism around the fact that hospitalisation rates will decline substantially as we move forward over the next couple of years. And so you've seen a repricing back of those shares. A2 Milk, which is another important constituent in the New Zealand market, delivered a pretty disappointing earnings result. And a lot of that was tied into COVID, and especially its impact around the Daigou channel, which is an important distribution aspect for them. And as a consequence, their share price fell also. So that's the combination of those two, and also some selling from offshore in our electricity stocks as a consequence of changes to the way in which indexes are being built around liquidity adjustments for businesses like Contact and Meridian, and the part that they play within those indexes also weighed upon the ultimate outcome for the local market.